Well, you made it. It is Friday, June 20th, end of the week. A beautiful day in Sonoma County, at least. And we hope you're having a great day, too. My name is Dano, Weir. I am the marketing director and podcast host for Sonoma Wealth Advisors. And this is On the Markets, our market show where we look at both the market and the economy with our managing principals, Daren Blonski and Chris Sipes. We'll get to them in a moment. This week, we are looking at the shocking disparity between your home payment if it was purchased on one line of the sand or the other, and that line is the year 2021. Also, which countries across the world are spenders versus savers? Just guess where the United States falls on that one. And we had something called a triple witching happen today, and things got a little dippy. And it all feeds into this idea of the K-shaped economy. What the heck even is that? We'll find out after this. All right, get them in here. It's Daren Blonski, CFP, Chris Sipes, CFP, the managing principals of Sonoma Wealth Advisors and our Fermata family of brands, including 401k, tax, and more. Guys, welcome to the show. Chris, you are educating me immediately right off the jump because I don't know what a K-shaped economy is.
Well, it refers, of course, to the letter K, where you have some that are on the uptrend and some that are on the downtrend, just like the letter K, right? Really great podcast this week that was on Odd Lots, which was Jim Egan. The title of the podcast is Jim Egan on the mortgage gap that's dividing America. Highly recommend it if you get a minute to listen to that. But it talks about a lot of the origins of the K-shaped economy, where some have done very well and some have not. A lot of that relates back to when you purchased your house.
Daren, as you've been working with clients this year, you kind of feeling that disparity between kind of the line in the sand when it kind of comes to who got their loan when?
Yeah, I have to be careful about how I respond to that question because I come from a very sociological thinking background. And when I look at much of what's going on throughout the economy, from the recent social unrest that's happening, I link a lot of social unrest to economic disparity, right? So there's a big part of me, it feels like a lot of the unrest we've seen socially around the world and also here in the United States is tied to economic disparity. And I think there's a big disparity about who got their loan when. And I think the disparity is growing throughout the United States and beyond.
Well, let's cheer everybody up with some political commentary or at least a cartoon, at least. Chris, what do we got here from Hedge Eye?
Yeah, it says, I said that we're a part of the K-shaped economy. I never said it was the good part.
Right.
Shows a husband and wife and a kid in a supermarket. So, and I think that's very, very real for folks. And depending on which side of that K-shaped economy you're on, you could be living two completely different realities here in America. So this is one of the charts from Jim Egan at Morgan Stanley. And what's cool about this chart is it shows the percentage of household income that goes to a mortgage. Now, Dan, I know you're somewhat familiar with mortgages, right?
I worked in the industry for a year, and I am familiar as a purchaser of them as well.
Yes. So anybody that's ever applied for a mortgage knows that they're going to take your income, right, and look at what you have to pay out of that income for things like credit cards and car loans, but also what you're going to be paying for this mortgage. Now, if you remember back to 2020, we were at historic lows in interest rates. I'm talking like thousands of years lows. And when that when that changed in 2021, when the Fed started to raise interest rates in response to inflation, that affected the cost of debt, the cost of money. That, along with the fact that home prices had ramped up dramatically, leads to this, which shows if you had your mortgage from previous years, the percentage of your overall income is very low. In many cases, less than 10%. In some cases, less than 5%. And but if you got it afterwards, you're pushing up into those high 20s in terms of how much that is taken out of your income monthly. And Jim goes so far to say that maybe it was leading to some of the delinquencies that you're starting to see in the debt markets, where it highs in the auto loan market, as an example. So back to the highs that we saw in 2008, where people are delinquent on their auto loans. But all that stress could be coming from those families that purchased homes and maybe had to stretch to get into that house, and now their income may be being affected from being laid off or whatever it might be in the economy, which is starting to lead to stress across the credit markets.
And then, Chris, you're also seeing that new glut of inventory suddenly get on the market as well. So there's another factor to add in. People who potentially stretched to get that property and thought, quote, rates will come down. Oh, when they come down, well, they ain't come down yet. They haven't come down yet. So that might help explain that factor.
Yes, and if I remember right, he says, I don't have the exact data to back that up, but he's like, I could see that being a logical explanation for that big burst in inventory that we saw, in last week's, or maybe 2 weeks ago, the Redfin chart that we were looking at in terms of inventory available versus the demand out there. It's just totally separated at this point.
I'll just hop on a small soapbox, not a really big one, but a small one. Because whenever you talk about the disparity in housing and specifically purchasing a home, it can be very depressing. And I don't just want to move on and say, yep, sucks, move on. I so wish that it was different. It's not. And so the way that the reality of the situation is, if buying a home is on your list of something you want to do in your life, I still think it's possible. You have to start considering areas that aren't necessarily your choice areas. You have to start thinking about being a lot less picky about the property itself. You have to believe that, putting your money in that is going to be worth it long-term as an investment. And then there are programs out there for down payment assistance and a whole lot more if you work with a really great lender or a really great agent who really is there to help you. So those are all things that you would have to compromise on. I'm sorry that you would have to do that, but it's not completely hopeless. Mostly hopeless, but not completely hopeless.
Yeah. Now, this chart, or this, I guess, illustration really surprised me. The manufacturing by state. Okay, we've got the U.S. here, and Dan, I don't know about you, but I would not have guessed that California had the highest manufacturing jobs by state in the country. But they do, followed by, it looks like, Texas, and then you've got a lot of the Midwest in terms of the manufacturing jobs. So I guess this is, I don't know really if this has anything to do with investing or whatnot, but just interesting, I guess, narrative shift. I just wouldn't have guessed, with all the headlines about California and how it's so business unfriendly and all of these things, that we would have the highest manufacturing jobs in the country, number of manufacturing jobs. Now, I know it's the, population wise that it would make sense, right? But you just don't hear that much about manufacturing jobs in California.
I was just thinking the other day, Chris, because I think that's mostly a result of size, if you ask me. I was just thinking the other day that if California was on the East Coast, it'd be like 8 states. It's just such a large swath of land that's part of the reason why I think it leads in so many categories. And then what's really crazy too is if you look at population density within California, I mean, most of the state's empty. It's like 2.5 areas and then a bunch of outlying, smaller, much very different communities. So, yeah, that's definitely a surprise to me.
Yeah. Yeah, it's really interesting. And they have a note here for Wisconsin ranks number eight in manufacturing jobs, despite having the 20th largest population. So pound for pound, a lot of manufacturing going on in Wisconsin, apparently. So we got the sentiment numbers this week, kind of meh, sort of unchanged. Not a lot of big changes here when it comes to bullishness, bearishness, and neutrality. We're running, kind of normal levels here. We're always looking for extremes to kind of fade those extremes. Usually, when people are really, really excited and bullish, that's not such a great thing for the market moving forward. And if they're the opposite, feeling bearishness, um, which, case in point, take a look at the 1 year bearish high in April so far would be the low for the year. And so usually when people are feeling really poorly about things, that tends to be a good thing for forward-looking returns. Now, the CNN Fear and Greed Index was at 54, which was down from 60 greed last week. That's considered a neutral reading on the CNN Fear and Greed Index. And Bitcoin at 57, which was still slightly greed, but down substantially from 71 greed last week.
So kind of middle of the road when it comes to sentiment. Kind of somewhat of a down week in the S&P, not necessarily a huge market jump out this week when it comes to a headline. Daren or Chris, is this a time when someone perhaps should consider, if they ever dreamed of changing their allocation or changing, their risk profile, would this be a time to do that? A boring time like Friday, June 20th?
You got to be careful here, but it's not actually an awful time to look at something like that, because the market is technically an all-time high right now, or close to an all-time high, within striking distance of an all-time high. So now's a much better time if someone were going to change an allocation than when the market's just selling off like it was back in April. It's a good time to just take a look and make sure that's what in fact and how in fact you want your money invested, if they were on the fence. But generally, it's not a good idea to change your allocation you pick your allocation and you stick with it.
For sure. Yeah, I'm not saying people should do that. All I'm saying is psychologically, this would be an example of you're not necessarily feeling a pull to quote, everybody's getting out, everybody's getting in, it's going to the moon, we're going to the floor, this is like a boring time. So maybe that is psychologically when you should consider something like that rather than when there's momentum.
Yeah, absolutely. I had a client ask, well, we're going through risk tolerance and such, and they said, well, I guess it would depend. I would be comfortable losing money depending on how long it would take to get it back. and I said, well,
join the club.
That's a really tough one to answer, but it's a great question, especially for someone that's, doesn't know a ton of market history, because if you look at like our last 5 years, we've had these relatively very quick drops, very quick recoveries. You take the COVID example, one of the fastest drops in history, and then we were back within like a month. It was insane how fast that happened. And so people forget about the longer time periods historically where it's taken. And you go back to a time like the Great Depression where the stock market was underwater for 25 years. So hopefully that never happens again. And there's obviously a ton different about the market structure now than was back then. But, the volatility is just completely different these days. At least it has been recently. Now we got a Fed meeting this week. They basically said we're not changing rates, which was absolutely expected by the market. There was all the futures market was not expecting any type of drop in the rates from the Fed. They're holding steady due to inflation expectations, employment. The Fed has always been reactive in the past, at least the modern day Feds, where they're going to wait until either the most likely until they see cracks in the labor market, extreme cracks, and or lower inflation to the point where they start to worry about deflation, and then they'll start changing the rates, which doesn't make a ton of sense when you think about it logically, because those rate changes take somewhere between 12 and 18 months to filter their way through the economy. So everything that we're going through now was from rate changes that happened a year and a half ago. So it's like steering the Titanic, and any little input has big downstream effects, right? But we're making those decisions in real time. It's kind of crazy.
Of all the ships you could have picked, Chris, at least you could have picked one that made it.
True. Well, and just to show you that the market hangs on every word that the Fed says, this is from Bespoke, showing the market reactions in the gray area is after the Fed talks, meaning the Fed Chairman Powell. The Fed, the market's basically flat leading into the minutes and everything. And then they literally analyze every single word, and they also compare those words to the words that they said last time. Like if they add a word or if they took a word out, what does that mean? I mean, it's really wild how they parse the Fed speak. But hey, it makes sense in today's markets where the Fed can have such a massive impact. We just talked about mortgages, and don't forget that the Fed moved into the mortgage market to back it up during COVID, which has not been something that they've done previously. But in the great financial crisis, the government stepped in to save the mortgage market as well. And so anytime you get tinkering with non-market forces, that tends to lead to distortions, good and bad, in the mortgage market. And I think we're seeing that now, and dealing with those issues now from all that intervention.
Daren, Powell is still there as the Fed chair, and there was such a buzz maybe a month ago that he was either going to get fired and or step down. Is there any more you're hearing or any more you've read about that?
Yeah, there's nothing really that Trump can do. I think Trump would love to get rid of him, but he's unfortunately not in a great spot to do that. There's a lot of pushback, and so it's interesting when the Fed they come out like they did on Wednesday and said, hey, we're basically not going to lower rates anytime soon. Today, Fed Chair Walters, or not Fed Chair, but Fed President Walters said, well, I could see rates going down as early as July. And I've noticed this pattern with the Fed. They might come out and say something, and they kind of walk it back with the other Fed presidents if it's a little too far and the market doesn't like it. It's clear from how the market acted this week that it wasn't so excited about Chair Powell saying, hey, we're not going to lower rates anytime soon. It is curious that every other major economic center in the world is lowering rates right now, and the U.S. is not. And so I think that's where the pushback is.
Okay, so the chart we're looking at here is from, I hope I'm probably saying this wrong, but it's Tyho Bracken. And he says the last 15 years have been the best holding period for the U.S. stock market out of almost any other. Since most investors missed it, there's a FOMO with the hope that the trend continues. Warren Buffett said it best: what the wise do in the beginning, fools do in the end. And we all suffer from something called recency bias, which is where we take and extrapolate the recent past into the future. And this is a long period of time. 15 years is a fairly long period of time for most investors. And it's hard to remember that, hey, this is actually one of the best performances that the stock market's ever had. And so will that continue over the next 10, 15 years? Maybe. I mean, I guess there's a chance, but I think you would want to take a step back and look and say, is this a situation where the risk is built up? Is this the forest that's been allowed to grow kind of uncontrollably without any type of setbacks to kind of reset from the risk perspective? And going back to the fact that really since the great financial crisis, the Fed's been there to backstop the markets all along the way. And people now have this Pavlovian response that when the market goes down, we buy the dip because somebody's going to step in, somewhere around 20% down in the markets, right? Now, of course, there's no guarantees, and it doesn't say that they could do that in the future, but investors have really been trained in that in the most recent past.
So reading this, if I'm an investor who's concentrated, so maybe you've got a handful of single U.S. tech stocks, right? You might be indicating perhaps, diversification at a time. We're just wondering if this uptrend is going to continue, especially if they're not lowering rates.
That's right. I mean, if you look at that period from 2010 to 2024, the average return was 12.2 versus the average for all time periods 5.9. So you're double, since 1970, those rolling 15-year periods, it's just been double in that time period. So you never know, right? It's just the law of large numbers. Now this is a chart from PIMCO. Let me read what they say. PIMCO says some countries are overspending while others maintain fiscal discipline. As the U.S. Congress considers bills that could swell already high deficits, investors are factoring countries shifting debt paths into their global capital allocation decisions. And if you can't see the U.S., it's down there on the bottom left, right above.
It's right down there on the bottom,
where it says "living beyond their means." We're lumped in with countries like Colombia, Brazil, Romania. Of course, the UK is in there, barely with us, but outside, where maybe in the slots where it might be a little safer, countries that are saving even more. You've got Denmark, Switzerland, Sweden, Japan, Korea. Now, Japan's an interesting one because their debt to GDP is way, way up there. So even though maybe their current accounts, they might be saving more, their overall debt load is massive. It's one of the largest in the world. So, but anyway, it's something to consider as we're putting together our budgets and looking at what happened this spring when we talked about the tariffs, and for the first time in really at most investors' lifetimes, where we've had the dollar going down, we've had rates going up, and people just basically selling out of U.S. assets that way. So stress in the markets, and you've got people selling treasuries, selling the dollar, and they say that is more indicative of emerging markets than it has been of the U.S. in the past. So maybe we're experiencing a shift in the global capital flows this year. It's probably too early to tell, but it's interesting that took place in the spring when we saw that global stress. And as a result of that, we've got the fund manager survey from Bank of America showing that most fund managers are underweight the U.S. dollars. In fact, they're the most underweight the U.S. dollar that they've been in 20 years, going back to, it looks like about 2005. And so that's a marked difference from 2010. So going back to that rolling 15-year U.S. stock market bull market, you look at most of that time, the U.S. dollar was fairly strong, with a lot of that time in 2010, the fund managers were overweight the dollar pretty significantly.
What does this mean, underweight and overweight?
It means like how much they are, the flows are going to it. So like dollar weighted assets versus say foreign currency assets, right? So overweight and underweight would be relative to their benchmarks usually. So most fund managers have a benchmark where they have to, or they're trying to beat it, but usually they're also following it somewhat. So they're they're usually referred to overweight or underweight relative to the benchmark.
And can you posit a guess why, either of you posit a guess why suddenly they're underweighting the dollar? I mean, is it political? Is it their opinion? Is it the fundamentals? Is it the debt? What could it be?
It could be all of those things, those are all reasons why someone would be underweight, if they feel that that the country's debt situation is out of control to the point where the government is going to have to come in and borrow more money, which drives interest rates up. Remember Big Papa Steve at the barbecue? He comes in and he takes all the food, right? So that's the analogy that my old economics teacher used to use and always brings to mind. So the more that Big Papa Steve needs to eat, the less there is for everybody else, or the more dear that food is, right? Which in this analogy would be the money. So the more money that the government has to borrow, it drives up interest rates, which makes money more expensive for everybody else, and then going all the way back to those mortgages, it really puts a lot of pressure on people that are getting new mortgages, as an example, which is usually the biggest debt that any of us take out, taking up a lot more of our income. It makes less room for investing, spending, et cetera, et cetera.
Well, it sounds like you haven't bought a Nintendo Switch 2 recently, Chris, because if you had, you would have known that is the largest debt that you would have had to pick up.
This is true, Dan. I have not picked up one recently. Here's the dollar, the DXY, over the longer term, though. And you can see that while it is definitely weak relative to any of the time that we've most recently seen here, call it since 2023, going into 23, on the longer term chart, it's really not as weak as we were coming into 2021. So the DXY is the dollar versus other currencies. So most notably the euro. The euro is the second largest currency in that currency basket. So it's measuring how strong the dollar is versus those other currencies. And so you can see on the moving averages, we just got simple moving averages here to show you the trend. And when you've got that 50-day below the 200-day, that shows a trend in the downward direction, meaning that the dollar is weakening. And that tends to be good for foreign currency assets. So assets that are, say like foreign stocks as an example, that tends to be a tailwind for them because their currencies are strengthening relative to the dollar. It's also a headwind for dollar weighted assets, which we've had that, extra push from the dollar being stronger, for much of the last 15 years. This was interesting from Charlie Biello. We got the CPI numbers this week, and he says the most absurd number in the CPI, he says, according to the U.S. government, the cost of health insurance has declined 18% over the last 5 years. Now, talking with clients, I would say that health insurance is the number one hot button issue for most people. Most people are the most worried about it, paying for it, going into retirement. I know as a business owner, it's probably the most expensive, line item related to hiring an employee. And so most of that burden in the U.S. falls on businesses, especially small businesses, given that they're the employer of most people. And so it's kind of laughable that the CPI says that we're down 18%. So if you go to the next slide.
Wait, is this just because they've been hiring less people? I mean, I don't believe this. There's no way.
Yeah, I'm not sure how they justify that, but Charlie Biello again, and he says the average U.S. family health insurance premium in the year 2000 was $6,000. Then he goes through the various years. In 2024, it was $26,000. That's a 342% increase since 1999, which is 6.1% per year. And he says, if you note the US CPI inflation, so all inflation, has increased at 2.5% per year. So more than double. The health insurance premiums have more than doubled the US overall CPI. So, maybe with all this AI, we will see some deflation and some relief in the health system. I was me, Dan, I eat those sardines, so I try to stay out of the US health system. That's my game plan.
Yeah, same.
But recently had an interaction with the US health system through my dad getting sick and having to be hospitalized for a week or so. And wow, that is, count your blessings if you're not involved with the US health system. Let's just put it that way. It makes no sense on any level. And, God bless the doctors and the nurses and everybody else. I know they're working hard in there, but it just seems like the way the system is set up is just so backwards and just hard as a patient to understand what you should do to help yourself. And you have no idea what anything is costing. And it's just a mess. It's an absolute mess.
I had an appointment recently with an unnamed Northern California health system, and the doctor had his door tapped on and informed that he could no longer be speaking with me because he'd passed his time limit. So just a little example there.
Let me guess, you were talking to him about Nintendos?
No, just you guys.
Lucky us. Well,
Dan, after all your Nintendo talk, I was in Best Buy the other day, and I must admit, I walked to the Switch aisle to see what was going on over there and try to increase my cool level with my 9-year-old. And, it was sold out, man. There's nothing there. It was gutted.
Yeah, it's been, for those who don't know, it's a fun thing I share with my kids, and or maybe for me. And so I always grind Daren and Chris about it. And if you've got one of those, where's the slide on that, Chris? Where's the Nintendo stock? Not stock, the inventory. You need to see what's going on with the Switch too. And let's get a slide for that next week.
Yeah, I'll get right on it, Dan.
Head to my house, Daren.
In the meantime, those that watch the show regularly will recognize this slide from a couple of weeks ago, which was, hey, if the U.S. stock market's expensive, if there's different areas that have really outperformed over the last 15 years, where might there be some opportunities? Where are the areas that are struggling, that nobody's there, nobody wants to be there, nobody's talking about it? Defensives, which is a term that is put together for healthcare, utilities, and staples. So the defensive area of the market, things that people end up spending money on, whether they want to or not. It's the lowest percentage of the S&P 500 since the year 2000. Now, market historians will remind you that the year 2000 was the dot-com bubble, where basically, if you didn't have a .com in your name or anything related to the internet at that time, nobody wanted to buy your stock. Sort of similar these days. And so you can see that these areas are stretched. Maybe there's some opportunity there to go search for some bargains. That's if fundamentals even matter anymore, which I think there's a healthy argument that nothing matters to the market anymore when it comes to logic and fundamentals. But another area, if you go to the next slide, is real yields. Now, I can almost guarantee, maybe some of you go to really nerdy barbecues, but you're probably not hearing about real yields at the local barbecue, which is the yield that you can get on a fixed income instrument over and above inflation. Now, they typically measure this using the government's issued fixed income instrument.
1 second, Chris. 1 second. What is a fixed income instrument for someone who wouldn't know?
Okay, that's for a bond, right? A bond, or you're loaning your money. You're loaning your money to some entity, in this case, the U.S. government. and they do so through TIPS, which is Treasury Inflation Protected Securities, is what TIPS stands for. And just like the name implies, they are quote unquote protecting you from inflation by giving you a rate of return plus the CPI. They'll pay you the CPI in addition to that rate of return. Now, that rate of return is determined by the market. It's what are people willing to buy and sell treasuries for. The inflation protection piece of it is determined by the CPI. And so this chart from Mike Zaccardi, he's saying the 30-year TIPS yield at 2.61% off the highs, but still near a 23-year zenith. So what that means is if you've got a real yield at 2.61, that means you're going to get inflation plus 2.61 if you purchase that TIP security on that particular day, right? And then if you were to hold it for the maturity time, in this case 30 years, you would receive that 2.61% plus the inflation rate. So right now that is pretty close to a 5% overall yield, which is competitive with the historical returns on equities. And so it's we haven't seen these rates since, again, around the .com bubble. And at that time, in hindsight, those were very attractive rates for those that purchased them. But like I said, most people don't look at these, care about them. You're definitely not tripping over yourself to call your advisor to buy some tips. But it's an interesting place to consider some long-term opportunities there.
We're going to get to Daren's charts in just one moment, but I have to ask you this because I'm a little lost. So that's my job on the show, is to be the idiot. Can we put some numbers to this? So this is a bond, and you're saying, hey Dan, I'm going to sell you a bond for $100, and over 30 years, it's going to pay you 2.612% plus inflation. And what does it pay me that every year?
Yes, you're going to get that. These pay biannually, I believe. There's an adjustment to the principal for that inflation. So you're going to get in your case, when you said, I'm going to pay $100 for it, you're going to get that face amount back at the end. Well, with a tip, they're adjusting that face amount based on inflation. So you won't get 100, you'll get 100 and whatever the inflation rate was. In 30 years, you'll probably get 400. I don't know. Depends on what our inflation rate is.
Massive.
I'm just kidding on that, by the way.
Yeah.
But you're gonna get that coupon. That's what they call that coupon, is that 2.6% in this case, and then you're gonna get the inflation adjustment to your principal based on the CPI.
Gotcha. Okay. One of the beauties of this show, Chris is what we call a fundamental analyst, not a fundamentalist, but he looks at the fundamentals of the market and the economy and some of the basics. And Daren is a technical analyst, which means, what's going on with the chart itself, sort of separate from all of those underlying fundamentals. And so we go from the first half of the show to the second half of the show. Daren, what do you got?
Well, as always, lots going on out there. Interesting week. I think it feels like there was two main themes, I think, for the week. One is this geopolitical tension that it's going on between Israel, Iran, Ukraine, Russia, and then how the U.S. is going to engage or disengage from either of those issues. That's kept the market really on pins and needles. And then secondly, all eyes on what the Fed's going to do. Are they going to lower rates? And when? Or are they going to keep rates the same? And what is inflation doing? Those seem to be what's driving the narrative of the market. When we look at it technically, though, it tells a little bit of a different story. So I put a box. This white box was put on by me, and this is the candlesticks for the last 5 days. So this was Friday, Thursday, Wednesday, Tuesday, and Monday in the market. We closed the market looking pretty good last week with a strong up green candle. You can see that candle here on the 12th of June. And then we gapped down. We went down, opened down on Monday, and then quickly saw a nice bounce on Tuesday. And then since then, it's been downhill. Now, I'm going to caveat all this. And as Dan, you talked about, it's the triple witching this week. And that's nothing super fancy other than the fact that what the triple witching means is that there's what's called options expirations. And so options drive a lot of the volume in the markets. And when the triple witching happens, the market's rather volatile. And that's what you saw today. Ugly close. This candlestick is an ugly close for the day. Let's look at it on the week. It's not a great candle. See how it's in. I'm gonna get rid of my cool little white box now, but we're engulfing last week's candle with a red candle, which typically says, we'll probably have a down week. I could very easily see next week being a down week. Lots out there that could help drive that down market. One of the pieces I'm watching, though, is this long-term trend line that we recovered from here recently. I could see a trade into this trend line right here and then a bounce up. I'm not ready to say that this market is over. We are literally just tapping on the all-time high level of the market. I talked about that earlier in the show. Now's a great time for people. If you're concerned about your allocation, you were concerned about how it performed when things went down a few months ago. Now's a really good time to look at those things, not when markets are bleeding and selling off. It's a good time to step back and say, is this allocation make sense? Does the risk make sense, etc.? We're literally knocking all-time highs in the S&P. I think next couple of weeks, I could see some down and testing this long-term trend line in the market on the S&P 500.
Daren, I don't want to break your momentum, but can you just clarify one more time what a triple witching is and what options are generally?
So generally, options are a mechanism for betting on the direction of the market in a particular stock or particular index. And when those expire, which they do usually on a frequent basis, there's these what we call a triple witching event where the stock futures, the stock index futures, and the stock futures all expire at the same time, and or the index futures. And when that happens, that brings in a lot of volatility in the market. Everybody has to well, not everybody, but the people who are playing with options, and usually it's a lot of rather big organizations, they have to kind of reset and redecide where their bets are going to be. Let's make it as simple as that. It's just about betting on the direction. And options are used for hedging downside. They're used for hedging upside. There's a lot of reasons people would utilize an option in their portfolio. But when they all expire at once, that kind of forces money to change hands and move differently in the market. And that's what we saw here just recently.
Gotcha.
Just today. And that created the volatility. So hard to really take the signal of today, given the triple witching, as anything more than just volatility created by the triple witching. However, I could see a little bit of downside to test this long-term trend line, and then resumption upward. Right now, I just don't see the mechanisms to suggest that, we're going to see a significant down market, even though the news seems to make you think that. Now, interestingly enough, this is the CME FedWatch tool. It's basically looking at the probabilities of rates being moved. I did mention earlier in the show that President Walters came out and said today that he could see rates moving as early as July. And I think that's overall fairly stimulative. It is curious that all the other major central banks have now moved rates down significantly. In some of the central banks, the rates are at zero again. And I think that's interesting that we haven't moved our rates at all, and that inflation is quote unquote so persistent. I think the tariff and the freak out from the tariff is making the Fed very uneasy about doing anything with rates at this point. When we look at the S&P 500 on the heat map, though, this is looking at one-day performance. Let's take a look at the 1 week performance, and you can see pretty red across the screen, a little bit of green here and there, but nothing really consistent. The fact that energy's up, that tells you, right, like, maybe something's getting signaled. Maybe the U.S. is going to participate. The market's thinking that the U.S. is going to participate in the wars going on in the Middle East. Well, I guess overtly participate. Right now we're participating, but not necessarily disclosing what level of participation we have. If we go to the oil market is curious to me. And you can see this is a long-term trend line on the oil market. And you can see it's hit this resistance, gone down, resistance, resistance, resistance. And we spiked through that and got rejected. But then the fact now that we've recovered up and we closed the week up inside what we would call this wick here, that tells me we're probably going higher in oil. I think oil is telegraphing to us right now that we're going to see the things in the Middle East get worse now before they get better. Last week, I felt like it was the opposite because we traded into this trend line, got rejected, and closed below it. But the fact that we revisited this week and we closed up above that, what we would call the bar on this candlestick, that tells you there's buyers. That tells you that the prices are probably going to go higher, and we're going to break out. When we break out, then it tends to go a lot higher. If we see the U.S. get involved in the Israel-Iranian conflict, we'll see oil go significantly higher, which could be the peripheral nail in the coffin when it comes to a recession.
Daren, you often associate the geopolitical events with the charts, correlate the two and how the geopolitical could affect the price, but then also the other way, and that you think the way that the chart is going could affect the geopolitical. Are you alone in that, or do a lot of financial advisors basically understand that's a reality?
I don't know how to answer that question. I mean, I think most people believe and think that the politics of the world and those are the power centers of the world, that those impact the markets on some level. The degree to which level is highly debatable, but I think it's pretty hard to disconnect the two. If nothing else, if you look at the amount of fiscal stimulus and monetary stimulus that's responsible for driving the markets the way the markets get driven. Perfect example, in the last administration, the Green New Deal was a big thing, right? And all these Green New Deal, solar, et cetera, companies were doing really great, right? Because money was flowing into them. It was easy to get loans for those things. Well, we've seen that reverse now. And if you look at these companies that were all involved with solar, they're having a tough time right now. And I think you can see that if we look at some of the exchange traded funds and where they show up in, the solar technology, et cetera. So, yeah, I think politics do impact the markets. I don't think we can dismiss their impact and influence.
Along with that, if you look up EIS is the iShares Israel ETF. Now, without knowing anything about it, would you guess that's going up or down right now? Probably because I'm asking you, you're going to guess it's going up.
Yeah.
And you're right, which makes no sense, right? From a logical standpoint, you wouldn't think that would be happening, but it is. And so I'm a believer, the market's going to do what it's going to do, and it's really hard to understand it, especially because it's looking out into what is likely to happen, not what's happening right at the moment, but what's likely to happen, and that result relative to the expectations. Is the important part.
I don't mean to put you on the spot. I only bring it up just because before I worked in this job, there was the news, and then there's the financial part of the news. And to me, just as a Joe on the street driving, listening to the radio, they feel like they're separate. And since I've worked here, a lot of advisors are like, no, this indicates that. And you see a lot more connection. The chart is not just the money changing hands. It can seem like a lot more.
Yes, absolutely.
Well, it's all interconnected, right? I think to me, that's the most interesting thing about the market, is that it's all interconnected and it's a giant puzzle that my mind at least really enjoys trying to solve. I don't think it ever will solve because I think that puzzle's constantly moving and changing and it's dynamic. But that's what interests me about the market is that it is this. There's these so many different facets, and that's why when Dan, you say he's a technical analyst versus a fundamentalist. Like my fundamental belief is that you cannot fully comprehend all the market. The only way to understand every input of the market is to look at price, because price, in theory, entails every known piece of data in the market, right? It's the brain trust of the entire participatory and environment of the market, and that to me is why price is so telling and so important. At the end of the day, I believe that price happens, and then we fit and construct the news to understand price. And that's really like when you listen to financial media, for example, people are like, why is the market up? Why is the market down? And they're out there trying to find these stories and extract. It's the same process we were talking about early on the show. We talked about this hour at 11:20 today, the market just dumped. And so then what I did is I started doing all this searching online and trying to figure out what news hit at 11:20, because something hit, because that market just sold off. The other argument is say, well, it didn't actually, there was no news that hit. What happened is this this here was resistance, and the market was going to trade into that resistance at that point. And when it hit it, it sold off. And why was that resistance? Because it was support over here. It was support right here. It was resistance right here. It was support right here. That was a psychological number that the market had attached to. So why did it sell off? Well, it sold under that. That's why a chartist would look at this and say, well, shoot, that was an ugly close because it didn't hold that support line. Should have broke above and came back up. This is the 5-minute chart, by the way, you're looking at on today. And so every 5 minutes is a candlestick. And the fact that it traded up, got rejected at that important support resistance line, and then went down is, indication of, okay, that was a really important point, regardless of what happened. You go out and search all the, LLMs or the chat bots or whatever, and try to find something that happened at 11:20 today. And there's nothing out there right now to explain that, other than the fact that it hit an important psychological point in the market. So that's why you go to chart, because price ultimately is the barometer of all information that is known in the market. And often why the chart can start telling us something's up, right? When we look at the oil chart, for example, and just a minute ago, I was talking about how it hit this trend line. It's still hovering up there, which tells you that there's a belief in all the data that is known in the market that the market could be, in fact, going higher. And that would be a signal that, in fact, the US is going to get involved. We're just making sure we get as many people out of the Middle East before we get involved. And it's that's why I guess the chartist looks at it. When we look at the bond market for our diversified folk, and this is the good news, bad news, like this also shows to me like, hey, there's strength in the bond market right now. It's coming up against this resistance line and looking at breaking through. And it, to me, the fact that it visited 1, 2, and now the third time, and it's still hovering there, we're probably going to get a break. So, Chris, you can do your excited victory lap for your bonds here in a minute. So that's what. So if that's true, then you would have to suggest that, okay, well, the U.S. 10-year bond, which is inversely related to the AG, which is the bond index, is now breaking below this trend line here. And the fact that it traded below and it's revisiting this support level, that tells you rates are probably headed down, which would then play well with the idea that, oh, wow, U.S. gets involved with Middle East. That pushes rates down. The Fed actually lowers rates faster than they're saying they were on Wednesday. That becomes stimulative, but does it actually sink us into a recession? That becomes the question. And I think that's what we're seeing. If oil goes up, that could be, the piece of straw that broke the camel's back.
Dumb question. Can the Fed change rates at any time, or do they have to change it at meetings?
They could do it any time. They've historically, so many years back, the Fed would just change the rate and tell nobody about it, right? But Janet Yellen was particularly helpful in this, where they started communicating more with the market, right? Because the idea is that you can effectively manage the market, manage inflation, manage the economy just by communicating we will or might or could do this thing. And so in recent history, the Fed has been much more transparent about what they're doing. That hasn't always been the case. There's these people we call Fed watchers these days, right? That hang on to literally every word that comes out of the Fed, and the market responds to it. That's a more recent phenomenon in recent years, because the Fed realized that they could manage the economy just by the words that they use. So, the story I think right now is that the market's kind of on this like teetering line of like we're at all-time highs. I don't think it'll take much to push above all-time highs. Maybe we get a surprise piece in the Middle East, something like that. But I also think it could very easily go the other way. I think what's on store for this chart, though, first is a test of this trend line. You can see this break above it. We're going to come in and test it and then maybe resume higher. I think that's what the chart's telling us. So I do expect the next couple of weeks to be down weeks. Given everything that's going on geopolitically, there's plenty of excuse for the market to have a more rough couple of weeks. All right. I mean, we could talk Bitcoin if you guys really want to. I know Chris is on the edge of his seat, wanting to talk about Bitcoin.
We serviced me with some Nintendo talk. I feel like we have to even things out and give Daren his Bitcoin time.
That's right. There hasn't been much going on there lately, it seems so. Yes, enlighten us.
I think it's kind of bad news for the Bitcoin chart, to be honest, because you kind of got this double top thing going on right there, McDonald's. If we break below 100,000 a coin, then I think, we look at 96. But I think the risk is to the downside at the moment. I don't think it's to the upside. But we shall see. And Bitcoin tends to be a leading edge, a risk off, right? Seems to be how it's lined up over the recent years. And if that's true, then that would support the thesis that the S&P is going to check this support line here. And Bitcoin is also going to check 100,000 and make sure there's support there and buyers. When I mean support, I just mean buyers. People step in and say, oh, I'll buy that at that price. When I mean resistance, it just means a seller say, oh, well, that's overpriced. I'm selling it. That's all support and resistance means. And so the charts, when you look at them, are just, areas where buyers and sellers were battling out price. Buyers, sellers, buyers, sellers, sellers, buyers, buyers. And it's just a debate of buyers and sellers about what fair price is for whatever asset that's trading. And because there's no way for the human mind, maybe someday with AGI, we'll be able to comprehend all that is out there of all the data points that exist to go into price. Price is the perfect AGI, in my opinion. It is the perfect summation of all opinions that exist and have influence in the market. All right. Well, we will leave it there, I think. Lots more we could talk about, but generally, we'll see how next week goes, and hopefully things calm down here.
So in summation, wrapping things up, we had a triple witching, which was the expiration of options all at one time from three categories, which we believe may have impacted a bit of a dip here at the end of the week for the S&P. And Chris, we talked about a K-shaped economy. Just for everybody again, one more time, because we kind of looked at the disparity between two groups of people who got their mortgages either before or after 2021. Again, one more time, what is a K-shaped economy for people who are wondering?
It's simply just referring to the shape of the letter K, where you have, part of it going up and part of it going down. And it's referring to, two different demographics within the economy, those that are financially secure, probably got their mortgage prior to 2021, may not even have a mortgage at all. doing very well versus those that don't, and probably experiencing a totally different economy.
Thank you so much for checking out our show on the markets. We are Sonoma Wealth Advisors. You can learn more about us at sonomawealth.com. And if you are a client, we appreciate you learning more about what we do and what we're looking at. And if you would like to become a client, that's where you learn, sonomawealth.com. Also, wherever you found this show, make sure to subscribe. We're always looking for more subscribers, and we appreciate all the support from everybody who listens. And we will see you again next week.